We've had such a great run in equities, both in the US and Europe, on this optimism of some sort of deal by year end. When you see headlines like this, President Trump saying he doesn't really have a deadline in mind, are you tempted to take some equity risk off the table into year end?
We actually, on our models, exactly as you say, a lot of the risk trades, they are too high relative to where the macro data is. So cyclicals versus defensives, 10% too high, equities around 5% too high. But for us, it's always important, where are we going to be in 6 months' time? In 6 months' time, we think growth momentum will have recovered. We think ultimately there is going to be a deal because it's in the incentive of both sides, especially going into the US election. And therefore, I would say in the near term, we've got overshot, but we still have around 5% upside over the next 6 months. So we stay positive.
Is that what the volatility indicators are telling me? I looked at the VIX over the next 30 days, and there's a real stoicism, Sebastian, in the S&P volatility. It's hardly ratcheted at all. So is it the equity traders are right and that the bond traders that dropped and plopped by 13 basis points yesterday are wrong? Is there more mileage to go in the bond market versus the equity market?
I would say there is. So historically, the main driver of the US bond yield is the global growth momentum, which for the first time effectively since early 2018, the best indicator that we have of global growth momentum has just turned neutral. That's the rate of change in the global PMI. It was in negative territory for 18 months. It has just turned neutral. And relative to that gauge, the US bond yield is still around 30 basis points too low. So I think the bond market is still priced for excess pessimism.
Okay, so the bond market pricing excess pessimism. Some might argue that the equity market is priced for excess optimism. So if you go below the surface, rather than looking sort of at the indexes, how would you be wanting to trade the possibility of an extension of these talks into 2020 rather than a phase one deal by year end?
There are some interesting opportunities in the equity market because we've got some of the defensive sectors that into that rotation when the phase one optimism was really taking hold, they've just been thrown out of the window. And I'm particularly thinking about the food and beverage sector. Historically, it tracks the US bond yield very, very closely. But now it's a stunning 15% too low relative to where yields are. So there's a real mismatch. That's exactly the difference between equity optimism and bond pessimism that you see. So if you think things either are going to go wrong or it's going to take a while for the agreement to come through, here's one defensive hiding place that is very cheap at the moment.